Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, today we're diving into a U.S. market analysis from Monday, March 23rd, 2026.
This video presents a direct informational narration of the source document.
And of course, a quick but important notice before we jump in. This is for informational purposes only and does not constitute investment advice. So let's start with the core summary. The big picture right now is that the market's logic isn't really driven by fundamentals. Instead, it's all about high-frequency geopolitical headlines. We're seeing this convergence of the U.S. military's logistics window in the Middle East with a really significant options expiry coming up on March 31st. And that combination has basically turned the S&P 500 level of 6475 into a critical line in the sand for market liquidity, a potential trigger for what's known as a negative gamma feedback loop. We'll get into exactly what that means in a bit.
To really unpack all of that, we're going to break this analysis down into 6 parts. First, we'll look at market logic and geopolitics. Then, we'll do a check on some real physical indicators. After that, we'll analyze institutional positioning and automated system flows. That will lead us right into the heart of the matter, the 640.75 negative gamma cliff. And finally, we'll wrap it all up with some risk scenarios and recommendations.
Okay, Section 1, Market Logic and Geopolitics. We're going to talk about hedging, noise, and this pattern of intraday mean reversion.
And the key takeaway here is, well, pretty stark. Market volatility is basically being dictated by short-term diplomatic games. The analysis suggests that Trump's proposed 5-day ceasefire agreement was likely a strategic hedge, a way to manage perceptions around the very specific timing window needed for the assembly of U.S. ground forces.
And you can see this conflict playing out in the market action. First, you had the ceasefire signal. Trump proposes the 5-day agreement, and the pre-market rebounds on that news. But then, just 1 hour later, you get this contradictory physical action. The Israeli Air Force launches fresh strikes on Tehran, completely undermining that signal. The institutional assessment here is that this 5-day window aligns perfectly with the time required for U.S. ground forces to complete their assembly in the region.
So if we can't trust the headlines, where do we look? That brings us to Section 2, the physical indicators check. We're talking about tangible things like energy prices and traffic through the Strait of Hormuz.
Now, the main takeaway from looking at the hard data is this. The recent dip in energy prices hasn't come down nearly enough to signal a true easing of the crisis. The real litmus test, the core reference point we need to be watching, is whether or not traffic through the Strait of Hormuz is actually moving normally.
You see, while all the diplomatic noise is happening, this physical data gives us a much-needed reality check. Brent crude has fallen back below $100, which sounds good.
And WTI is heading back towards 90. But let's be clear, this $90 to $100 range still reflects extreme stress. A true all-clear signal would only come if we saw prices fall back into that $70 to $80 range. We're just not there yet.
And if we look at the real-time vessel tracking in the Strait of Hormuz, the picture becomes even clearer. As you can see from these observations, the main shipping lane, the Strait's center line, is largely cleared out. Vessels are clustered near ports, not moving through. The strategic conclusion is simple. Traffic is not normalized because global shipping operators remain extremely cautious.
All right, Section 3. Let's look under the hood at institutional positioning. We're going to examine how big funds are deleveraging and the risk of what's known as a short covering trap.
And here's the bottom line on positioning. Net exposure is still at a historically high level. What that means is the market's defensive posture is, frankly, still vulnerable, especially if we get hit with one of those negative gamma events we talked about earlier.
Now, we are seeing some de-risking. For instance, hedge fund gross leverage has dropped for 2 consecutive weeks, now down to 214%. This points to a more orderly, controlled reduction in exposure, not some kind of panic selling. But here's the twist. Net exposure actually rose to 53.7%. That puts it in the 71st percentile for the past year, which is quite high. It's really important to understand why it went up, though. It wasn't because funds were adding new long positions. It was driven by short covering. And that subtle difference means the long side of the market is still very crowded, and therefore very vulnerable.
Okay, next up, Section 4, let's talk about the machines, the automated system flows. We're going to look at the predetermined selling path for these systems and what kind of dry powder they might have on the sidelines.
The key takeaway here is simple and direct. For the big commodity trading advisor systems, or CTAs, there is a clear line in the sand.
Until the S&P 500 can close firmly above 6753, their default path is to sell into any strength.
So here are the key quantitative thresholds for the S&P. The buy triggers are at 6753 and 6812. If the market gets through there, it could release about $70 billion in buy orders. On the downside, an accelerated sell trigger sits at 6381, which would add pressure towards the 6100 level. But a true trend confirmation signal, the real bullish trigger, isn't until all the way up at 6980. So until 6753 is reclaimed, selling remains the path of least resistance.
Now, everything we've discussed so far brings us to Section 5. And really, this is the core warning of the entire analysis. We're talking about the 6475 negative gamma cliff, the single largest near-term hazard in this market.
So, with all this derivatives pressure building up, what is the biggest technical hazard we're facing in the near term?
The answer is a single number, 6475 on the S&P 500. This is the level that longs absolutely cannot afford to lose, and the reason is it's tied to a very large JP Morgan option structure known as a collar that expires on March 31st. A key part of that structure is a huge long put right at the 6475 strike price.
And here's why that level is so dangerous. It creates a potential delta hedging feedback loop. You see, as long as the market stays above 6475, dealers who are short those puts have to buy stocks to hedge their position. That actually provides passive support for the market. But the moment the market breaks below 6475, everything flips. Those same dealers are then forced to sell a large amount of stock to rehedge, and they have to sell into a falling market. This forced selling can create a vicious negative feedback loop, especially as we get closer to that March 31st expiry.
So finally, let's put this all together in our last section, risk scenarios and recommendations. This is a framework that's built around that key physical indicator we talked about earlier, the shipping cycle.
Okay, so here are 3 possible scenarios, all tied to the timeline for reopening the Strait of Hormuz. Scenario 1, the best case. Shipping resumes within 2 months. If that happens, the S&P 500 down at 6100 becomes a strategic buying zone. But if it takes longer, say 2 to 6 months, we're in Scenario 2. In that world, the 6100 level likely fails, and the market probably shifts its focus down toward 5500. And in the worst case, Scenario 3, if there's no resumption after 6 months, we're talking about structural damage to the global energy supply. And in that situation, a lot of our traditional valuation models just fail.
So what's the operational recommendation based on all this? It's really about managing your error tolerance through diversification. And ahead of that March 31st inflection point, you need to pay extremely close attention to those mechanical levels, both from the CTA systems and from the dealer hedging we just talked about.
And we'll close with one final important notice. This document is for informational and research purposes only and does not constitute financial or trading advice. Really, the question this whole analysis leaves us with is, in a market balanced so precisely on these geopolitical headlines and automated triggers, is the biggest risk not what we know, but how fast the machines will react when something truly unexpected happens?